It's shocking that prices have gone up in this scenario where payments have doubled. And you
Right.
still have to put down payments, and you still have to qualify and show every document that you have, and you have to have amazing credit. And yet we still, under those circumstances, are seeing prices go up. Isn't that amazing?
Hey, yo, hey, yo, hey, yo. Welcome to another episode of The Remote Investor. I'm Michael Albaum, and today with me, I have a very special guest. She's a podcast host, investor, syndicator, mother, author, among many other things. Kathy Fettke is going to be talking to us about what do we need to be aware of with the economy and what the hell's going on. Let's get into it. Kathy Fettke, welcome to the show. Thank you so much for taking the time to come hang out with me today. I really appreciate it.
Thanks for inviting me.
No, I am super, super excited to have you on. I've been a big fan of yours from afar for a long time based on the podcast and the work that you've done. But for anybody who maybe isn't familiar, can you give us the quick and dirty who you are, where you come from, and what are you doing in real estate today?
Oh, thank you. And I'm Kathy Fettke, co-founder of RealWealth. We have over 88,000 members now. We help basically people on coastal markets, high-priced markets, invest where it makes more sense, where you can get cash flow, where it's easier to be a landlord. And we have teams set up in different markets to help them make it more turnkey and easier for them.
Love it. Love it. Well, I know that you host a podcast as well, and you're so often talking about data and macroeconomic things. And so I would love to pick your brain on kind of what's going on in the greater economy today, if that sounds good to you.
Yeah, I'm obsessed with the topic because I think most people get caught off guard. And certainly in 2008, so many people, millions of people got caught off guard when they really didn't need to. The signs were there. So you gotta be able to read the tea leaves. It's just going to make all the difference. So right now, those tea leaves are a little messy.
Yeah.
It's probably, I've had a lot of economists on my show, and they've all said this has been the hardest time to predict anything because we have a president who's pretty unpredictable, but also predictable. It's not like President Trump didn't talk about tariffs in his his election campaign.
This was telegraphed. Yeah.
Yeah. It's like we knew this was coming. A lot of people, the question was, is he faking it? Is this just threats? Is it real? And we still don't really know. We still don't really know if this is just negotiating or if these tariffs are here to stay. So as a result, it's hard to predict inflation. It's hard to predict economic growth. I think for a lot of people, just the fact that Trump was coming back into office had people think, oh, the stock market's going to boom and real estate's going to boom. And a lot of the actions have kind of done the opposite, as we know. So, very difficult. If you are heavily invested in the stock market, you're feeling it real bad, right? If you are heavily invested in real estate like I am, and I've had a lot of people say, how could you be so overly invested in real estate? And today I'm like, hallelujah, because what? My rents haven't changed. Nothing's changed in my world.
Yeah.
And so I guess the bigger picture is if you own and operate real estate, buy and hold real estate like we do, we also build, you have demand. You have this massive population boom of millennials, the largest in history, the largest generation in history, with the largest group of them at first-time homebuyer age, first-time family formation age. They're getting married. They're like age between, I think it's 30 and 42 or something. I don't know what it is, right in this moment, but we're talking about people basically in their 30s who typically settle down. So a lot of the talk about millennials was they were going to live downtown and in apartments. And that is always true for people in their 20s, not just a millennial thing. When you get in your 30s, you fall in love and you have kids and you have pets and you want to not maybe live in that downtown apartment anymore. You want your kids in a good school district. So we're seeing massive household formation at a time when builders, there's inflation has been an issue for a while. Building has been behind, not anticipating this boom over the past 10 years. So we're still in the same story of not enough housing inventory for the demand. So those of us who offer rental property and offer a solution providing housing, we're not feeling the pain right now. Not,
Yeah.
I mean, probably some people are, but a lot of people,
Yeah.
it's just another day, right?
Right. And that makes total sense. So you mentioned something, Kathy, that you also build. And so
Yeah.
I'm curious to get your take on like what's going on kind of nationally and then maybe more locally where you've decided to build.
Mhm.
Why did you decide to build where you're building? And then once we tackle that, I want to hear about how tariffs are impacting that side of your business, if at all.
Well, listen, we survived COVID and nothing could be as awful as that. So,
I know.
we couldn't even get supplies. They skyrocketed. So this is a sunny day for us in construction. I know there's a lot of headlines saying that costs are going up. A lot of bigger builders have already seen this coming and they've stockpiled. That's why we saw the GDP kind of go down in Q1 is so many big companies are like, I got to get all the things now,
Right.
but stock up on it. So we are building in San Antonio. We're building a lot of places. We've got properties that are subdivisions in Florida, in Reno, Nevada, and Carson City, Nevada, and Oregon, just kind of across the board, and Texas
Wow.
for sure. But those are mostly building to sell to homeowners. We did our first build to rent community in San Antonio, just closed that offering actually this month. And nothing's really changed in our pro forma yet. But again, 3 or 4 months down the road, we don't know. So we're stockpiling too. We're making sure we've got everything we need just in case prices go up. But the reason we did it is, again, we know that there is demand. There is so much demand for rental housing. There's demand for affordable housing that people can buy and afford to buy. So, the homes that we're selling retail to just home buyers, we're trying to keep those costs in the median house price of the area.
Yeah.
And the same with the build to rent. Our plan is to build by apartments because we figure people, and if we can keep the costs similar, where they only have to pay a little bit more to live in our build to rent community, and they get a yard, they get a half of a duplex with no parking issues and stuff, that would be attractive to people who are maybe looking at the apartment next door, not next door, but down the street, and would prefer to be in our place for not that much more.
Yeah, that makes total sense. I want to understand, Kathy, better. Maybe you can explain for our listeners too, like the due diligence that you're doing when developing. Is that any different than if somebody is just getting started investing and trying to figure out what market they should go invest in because they have the entire country at their fingertips? I mean, how do you drill into the details and kind of parse out from all of the noise that we're hearing that real estate is falling or there's a massive recession coming? Like, how do you drill down?
Yeah, it's similar and different. Construction is riskier. I mean, flat out, that's the
Yeah.
difference. If all you have is dirt, you are hoping that things go well, that you could eventually have something there you can rent out. But in the time that it is not built, you've got overhead. So you've got to be really have plenty of reserves. You've got to be generous in the fact that there will be delays. Two mistakes I've made in the past is thinking, oh, we're going to get this project done.
This is the schedule.
We're going to stick to
the
the schedule. It's going to be on time and on budget. And it never is.
Never is.
Never. If you're investing in someone's development deal and they have not set aside reserves or thinking that it's just going to be all rosy, to get out of that deal.
Yep.
I've done enough of these. There's always something. Even the easiest project turns out there's always something. So that's the difference. Is you're buying dirt, you can't rent it. If you're buying an investment property, you have an asset, and that asset has hopefully somebody who there's demand for it. A big mistake investors make is they might see a cute house or a nice looking property and they haven't really looked at what's the demand for that property. If it's out in the boonies, no one wants it. People want to be pretty close to where they work. I try to stay within 20-minute drive from a work center, but ideally even closer.
Okay.
So just, making sure that there are jobs nearby, that there's a wage growth in the area, that crime rates are low, good schools. It's just basic real estate that will, once you have that asset, it's valuable. I've been through enough recessions. I've been through enough terrifying times. I'm old. So, I went through 2008. I went through 2001, the big recession, the tech recession
The
in San
.com,
Francisco
yeah.
Bay Area. Housing wasn't terribly affected. And of course, we saw that the biggest collapse in real estate prices in 2008. But it didn't collapse? Rent.
Rent.
Because you've got people who moved out of the houses that got foreclosed on, but still wanted to live in the neighborhood and just had to rent. So they're going to rent the same similar type house. And if you are the landlord, you have a client, basically. So we saw, and again, it depends on where we look for areas with job growth and population growth. But I helped hundreds of people buy properties in Texas before the housing crash of 2008, and they did not feel the storm because there was enough demand. More demand than ever for rental properties during that time. That's the lens you have to look for, not the headline of, oh, there's a housing crash. Well, for who? For who? Not for the landlord.
Yeah. And I think that's something that we so often get swept up in is these massive headlines. And if it bleeds, it reads, right? This is happening, massive, whatever. But you have to understand it's so hyper local, kind of to your point, in the Bay Area.
Yeah.
You didn't feel it. In part of Texas, you didn't feel it as much.
But those headlines are not meant for you as an investor. They're meant for the average population, people looking to buy a home or who own a home. People who are like, should I sell my home or not? Should I buy a home now or not? Those headlines are almost never targeted to an investor. And an investor, therefore, should look at every headline and do the opposite. And that's kind of been our thing. Like 2022, Jerome Powell, the Fed chief, said there's going to be pain in real estate. He said it. And he said, we're going to hike rates and there's going to be pain and there's probably going to be a recession. What did people do? They ran out of real estate. What did I do? I ran in. I started a fund right when he said that. And we just started buying up properties all over the place because no one else was there. We had zero competition, but there was still more demand than ever for those rentals.
Yep. Yeah, no, that makes total sense. That was something that always kind of perplexed me because we were talking about Trump telegraphing tariffs. Powell said the same thing. They said, we're going to raise interest rates. And then that happened. Everybody was like, holy crap, I can't believe he raised rates. It's like, wait a minute. We all knew
he kind of said he was going to.
Right. Yeah.
Yeah. It's an investor. I've discovered over the years, and I've been investing for over 20 years, that optimism is really not your friend in real estate. It's almost, and I'm a natural optimist. So it's been hard for me to change that about me. But optimism is what will kill you in investing. Because
oh my gosh, totally.
It will, and so many people were like, these rates are so good and they're going to stay this way. I'm like, when have they ever stayed at 2 or 3%? Like that is not going to happen.
Yeah. No, okay. Yeah. That's optimism is what definitely killed several of my deals. Cause I'm kind of like you, a natural optimist, but it's funny because I come from the insurance industry. So I have this pessimist part of me as well. I'm always looking for how things are going to go wrong.
Yeah.
But it's like this internal battle. And sometimes the optimist wins. And that's when I get myself in trouble with these deals.
And you're not alone. So many people did. In fact, I almost fired my underwriter because through 2021 and 2022, he turned down every commercial deal that came across my desk. And I was watching on Facebook, getting all this FOMO, everybody buying apartments. And I'm like, why is my guy turning everything down? Turns out he was right for that reason. Like it didn't pencil at higher rates. And he knew there would be higher rates. Eventually, if your business plan is to acquire a property and fix it up and then sell it in a few years, you better be able to, you don't know what's going to happen in a few years. So that plan better have several exit possibilities.
Yeah. Well, hopefully your underwriter got a bonus instead.
Yeah. I didn't think about a bonus, but we didn't fire him. But I like that. But you're right. Like he protected us so much and I was frustrated. I just felt like a loser. And then I started to go to, events and talk to other apartment owners, and they're like, that are really experienced. They're like, oh no, nothing will pencil if you underwrite it properly. Nothing's going to pencil.
Yeah. And I mean, that's such a good takeaway for everybody listening is like, it's so easy to get infatuated with the big, sexy numbers, the big, sexy deal, but you really need to be focusing on how to protect the downside. And how do you keep your pants on when things go totally sideways? Because I think a lot of people just got too excited about the big numbers.
Well, and it was exciting. People were making millions and millions of dollars. They'd buy an apartment and sell it the next year for 50 million more. I mean, it was very exciting. And like I said, I had massive FOMO, but that's like passing the potato. You don't want to be the last one holding it, or the hot potato. And that's kind of where it ended. So if you timed it perfectly, you would have made a lot of money. But if you didn't, it's hurting a lot of people today.
Right. And I mean, so you brought up earlier 2008 and tea leaves, and this kind of feels very reminiscent of that, where people made tons of money leading up to there, and then a bunch of people got left holding the bag. So I'm curious, Kathy, in your opinion, your estimation, like, is this a 2008 scenario? Are we kind of repeating history here, or is this different, and why?
Such a good question, and it depends on the asset class in real estate. Back then, I was a mortgage broker, so I saw all the fraud that was happening. I was right there. I turned in a loan once to the bank, and the bank came back and said, "Oh, sorry, your client doesn't qualify." And I was like, "Oh, okay." And he goes, "Oh, that's okay. We adjusted his income. Now he does."
We moved a couple of decimal points.
Like the bank did that. It was
wow.
Crazy. That's when I knew something was really terribly wrong. But back then, the typical loan most people were in single family housing was adjustable. That's just what you just wouldn't get a 30-year fix because you could get such a good deal on an adjustable rate. And everyone was doing it. And I was offering people these loans. I just didn't really understand what, I guess I pretty quickly understood. I knew that lying on your application was bad. But what I couldn't understand is like how they were offering loans on a teaser rate, meaning that it was just not the real rate that they were qualifying people on. And as soon as it would adjust, the person couldn't qualify, but they'd still give the loan out on the teaser rate. Like that.
And the teaser rate was for a short amount of time, I'd imagine.
Yeah. So like maybe a year and maybe 2 years, but it was going to adjust and heavily, like double the payment. And there was no way these people were going to be able to make the payment. So it was confusing. Like, why would anyone offer this kind of a loan?
Yeah.
I knew it was going to blow up. But so coming back to like what happened, most people were on adjustable rates. And when those rates adjusted, as was expected, they couldn't make the payments. And we know what happened. Foreclosures everywhere. The banks learned really quickly that foreclosing on a bunch of properties and then putting back on the market is not good for them. So I don't think we're ever going to see that again. We should have, because commercial real estate is on adjustable rate. Most of it's on adjustable rate. And those rates adjusted to much, much higher interest rates, and the payments doubled, if not tripled. Now, it's one thing to have a $200,000 property where the mortgage payment doubles. Very different when your debt is $2 million a month or whatever. Like it's a very different story with commercial. So when those, when the debt service doubled, if not tripled, there was a lot of commercial real estate that should have gone back to the banks. But the banks, they're not going to do that. They're doing the extend and pretend. They're finding private equity that will kind of come in and help with the deal. So commercial real estate should have crashed. It didn't. But moving to single family, ever since 2012, Dodd-Frank came in, and we had the Dodd-Frank laws, and they made it very, very difficult to get a loan. It's called a qualified mortgage. You actually have to qualify. The QM mortgages.
Full cavity search every time you go to get a mortgage.
And this is a down payment, and most people are on fixed rates, and the credit scores of those borrowers are incredible. They're over 700, over 720 in most cases is the majority, and very little subprime. So you cannot in any way compare single family housing or 1 to 4 unit housing today to 2008. There's nothing similar, except for it's expensive. Prices have gone up, but it's shocking It's shocking that prices have gone up in this scenario where payments have doubled, and you
Right.
still have to put down payments, and you still have to qualify and show every document that you have, and you have to have amazing credit. And yet we still, under those circumstances, are seeing prices go up. Isn't that amazing? And that just
It's
comes down
wild.
to supply and demand.
Yeah. Okay. All right. Well, so getting back to the commercial side of things, you said that there should have been a crash, but there wasn't. Have banks and lenders are they kicking the can down the road, and you think we'll see an eventual crash because they've got to run out of the extend and pretend methodology at some point? Or can they do this kind of indefinitely?
I think that's the big question that everybody's wondering. And every economist I talk to says, yeah, of course, there are some properties that are going into foreclosure. I personally know a lot of people who went gangbusters in 2022 and they're facing foreclosure today. So 2021 and so forth. So there are, but it's small. It's not enough it's really the investors who are losing their money and some of the banks that lent on those. But there's enough demand that it's not like those properties are just sitting. There's buyers for it. And so, yes, I think in some ways the banks are kicking the can down the road, but they've also found solutions. Like I said, private equity coming in, kind of saving the day, being able to take priority and, come in, get the property stabilized and hold it.
Mm-hmm.
Because one thing we know is if you hold real estate long enough, it usually comes out okay.
Yeah, totally.
You have to be able to hold it.
And I guess too, in thinking about kind of similarities between 2008 and today, in 2008, when the single family market was really at risk and saw so many foreclosures, you had a plethora of supply coming on the market all at once, versus in the commercial world, these are probably more one-off assets in various markets that are potentially coming online for sale, as opposed to entire neighborhoods, right?
Such a great point. I think at one point there was like 4 million properties in the inventory in 2007, something like that. So tons of supply. You had the Gen X, I believe it was the Gen X generation at that time, much smaller generation than today. So fewer buyers, way more inventory, and then these adjustable rates. Today, you've got the biggest population. You have barely, inventory levels are up, but nowhere near where they were at that time. I think like even a third of where they were at that time. Don't go look
you heard it here first, folks.
much less inventory, even though it's higher than it's been. But that's healthier, right? It's better to have a little bit more on the market so people have more to choose from. They can negotiate a little bit more rather than having to make a major decision in like 1 hour the way it was.
Right, yeah. No contingencies, no inspection.
Ridiculous, yeah.
Just crazy.
So it's a bit of a healthier market than 2021, I would say. Even though interest rates were low, people, they couldn't do inspections. That's crazy.
Yep. Kathy, I'm curious, since you do happen to know folks that are going into foreclosure, was it just I want to understand what went wrong, doing kind of a post-mortem. Was it as simple as they just predicted rates to stay lower for longer? Or were there other things that were maybe missed that we can take away lessons from?
If I were to...
Without naming names.
Not name names. They're hopefully not listening. I would say it's a combination of ego and optimism. So it's so
deadly combo.
Yeah, it's a deadly combo. And when you're in a real estate network, or when you're in a group, or you're in a mastermind, and everyone at the table is talking about their latest acquisition and how much money they made, you're like, oh, I want to be that person. I want to get up and talk about my deal.
Mm-hmm.
And investors were so optimistic as well, because maybe they did a deal with a new operator that they made a bunch of money because the timing was right, and they threw it all back into the deal. So investors weren't that savvy. They were very trusting. It was easy to raise money. And then the operators were the only way to get a deal was to tweak the numbers and be overly aggressive.
And overpay.
And oh my gosh, all of that. So I think honestly, it's just lack of experience would be what I see as the reason. And everyone I know who was in apartment buying and in commercial real estate for over 15 years. A lot of the people that are losing properties were in it for less than 10 years. So they only saw upside. But anyone who had done it before that and been through 2008 was way more cautious and not jumping in doing those crazy deals.
Yeah. Man, well, super, super good takeaways. Thanks for sharing.
But that's experience will knock your ego out. So, it's just when you're new, you just don't know, you get a little cocky and like, wow, I got this. I did it. I will 100% own that. When I started syndicating in 2009, my first couple of deals I knocked out of the park. My investors were making 40 plus returns each year. I mean, it was nuts. And I thought I was good. And I thought I was so good when in fact I just got lucky on a couple of, not lucky, but we did a couple of really good deals. And then I found out what I didn't know what I didn't know. And I syndicated a tech deal. What do I know about tech? Like, what do I know? It was a great idea, but implementation's a whole another thing. I syndicated a Shasta, a wine village in Shasta County, Northern California. Great plan, very hard to implement because what bank is going to say, yeah, I want to lend on a wine village? What is it? Banks want to lend on what they know and what has the lowest risk. So I totally know what it's like to have massive ego and optimism. It's just kind of like, I can't lose. I look at me, I'm doing great. And people are throwing money at me. I got to do another deal. I know it. And then I got humbled.
It's funny. I'm right there with you. And I think it only takes your getting your lunch eaten once to kind of set you right and be like, oh, I need to slow down.
In my case, more than once, but yeah.
I love it. Kathy, I want to ask you one more question and then we'll get you out of here. Is there a recession coming?
Probably. I don't know. I don't know. I mean, we're learning, right? We're learning as a country. We're doing something different. Anytime you do something different, there's consequences. So I think those consequences are being learned. It's either going to work or it's not going to work. That's what it comes down to. It's either going to be unbelievable or it's not.
Right.
I'm not worried about the asset class I'm in, which is providing affordable housing to people. Either way, recession or not, people prefer to live indoors. So for me personally, I'm not worried. But if there's a recession and people are losing their jobs, that can affect rents by all means.
Right.
Got to have plenty of, I would say, because of the unknown, you need to have lots of reserves on hand. That's how you get through these recessions. And low leverage. I don't even worry so much about low leverage as the ability to make the payment. I'd rather see someone high leverage, put less down and have the money they would have put down, put it in a bank so that you have it. The key, as we talked about earlier, is being able to hold the property. So if someone loses their job and you have to find a new tenant or lower your rents, you have the reserves to give you the peace of mind at night. You could put 50% down on a property and still not have enough money to make the payment if you put all your money in the down payment, right?
Right.
So I would say, because we don't know, because we're in this really weird time we're either at the precipice of the biggest economic boom in American history, or we're on the precipice of recession. No one knows. And anyone who tells you they know, they're lying. No one knows.
Through their teeth.
Yeah.
Through their teeth. Okay. Well, I lied. One more question for you as a follow-up to that. So we talked about how today borrowers are so much better qualified. They've got tons of equity in their homes, and they have probably really low interest rate and talking about owner occupants. If we have a recession and all those people lose their job, does it really matter how good of a borrower they were when they got qualified if they can't make their mortgage payment?
So, again, coming back to the people who own homes, they're in the best position a homeowner has ever been in that I know of. They are locked in. Most of them are locked into 2 to 3% loans, maybe 4%. They have, like you said, lots of equity. They qualified for those payments when they got the loan, and they had really high credit scores. These are people who know how to pay their bills. So my guess is they also are sitting on reserves and preparing and planning ahead. The people who got into housing, really, really, really had to qualify. So worst case, let's say they can't make their payment. Sell it. I mean, they have so much equity. You could discount your house by 20% and still walk away fine and with money in your pocket. and there's a need for that housing. So, could things get really, really bad? Of course they could. I mean, things could be terrible. But I just don't think that is what our government wants to see happen. So I think, the Trump administration is trying new things. They're going to find out pretty quickly if it works or not. And if it doesn't work, I think they're going to realign, because at the end of the day, we have an administration who does believe in growth, and this is, Trump has been, I don't mean to get political, but I will, Trump has been obsessed with the tariff idea since he was, I don't know, very young.
For a long time. Yeah.
Long time. And he's trying it out. And the world is giving him some pretty strong feedback. So again, it'll either work, it won't. If it doesn't, then something else is going to be tried, because at the end of the day, he wants a booming economy.
Right. Okay. Well, I've got the popcorn out and my drink ready. I'm going to sit back and watch how this unfolds. Kathy, this was awesome. Thank you so much for coming on and hanging out with me. If people want to reach out, find out more about you, your investing group, where's the best place for them to do that?
RealWealth.com is our website. It's free to join. Once you do, you can have access to a investment counselor to help you on your journey, and then get referrals to our teams nationwide. And then I've got the Real Wealth Show podcast and my book, Retire Rich with Rentals.
Love it. Well, Kathy, thank you again. We'll definitely be in touch. Take care.
Thank you.
All right, everyone, that was our show. A big thank you to Kathy for coming on. Super interesting things, taking a look at the macroeconomics. Important to understand that real estate is hyper-local, so don't get dissuaded by the headlines. Go look to understand what's actually going on in your particular market. As always, we love hearing from you. Ratings and reviews are super helpful, as well as additional content or things you want to hear about on a show or an episode. We look forward to seeing you in the next one. Happy investing.